Hello, welcome back to Intuitive Investing. Now we need to we need to have a talk, right? Because this is probably going to be my most controversial video ever. It doesn't matter how many videos I make, this will be probably the most controversial. It challenges a lot of misconceptions that permeate all of financial media. And really this topic really interests me. It's something that took me a long time to understand. And I really hope this video helps clarify a lot of these misconceptions that I had and that a lot of people have about the monetary system, right? Money. How is money created in modern economies, modern developed economies like the United States, Japan, UK, etc., right? And really, the main thing to take away from this YouTube video is that the Fed is not printing trillions and trillions of dollars, right? That is a misconception. At best, it is outdated. At worst, it is incorrect. It's just there's a lot of nuance, right? The Fed has a lot of influence over the creation of money, but they themselves are not creators of money. So the nuance here is we need to differentiate between a bank reserve and money that you or I are able to spend, right? So when the Fed wants to ease monetary conditions, they have several channels of doing this, but the most controversial seems to be open market operations or more specifically quantitative easing, right? That's what tends to get associated with money printing, like endless money printing. But what's happening here is they're exchanging short-term government debt for bank reserves, right? Bank reserves are a special kind of money only banks are capable of using to settle a flow in the central clearinghouse. They're not spent by you or I. And I just want to show you this graphic here. So you can see here, this is the bank reserve here. You see in 2008 financial crisis, and we'll get into why later on in this video, but in the 2008 financial crisis, what happened to bank reserve supply? It completely skyrocketed. And look what happens to M2 money. Yeah, there's a bit of a blip. There's a bit of a blip in M2 money, but it wasn't the skyrocketing we saw in M2 money that we would have expected under the assumptions made by people who believe that the Fed is printing trillions of dollars. What they're doing is printing trillions of dollars of bank reserves. Now, what are bank reserves, right? Like I mentioned, bank reserves are essentially a special kind of money that are only used by banks to settle a flow in a central clearinghouse, right? When a bank must settle a flow if the capital they lent leaves their bank and enters another bank. Let's say I go to a bank, I say, hey, I want $100,000 for my business. I'm going to sell, bread to the town, right? I'm a great baker. I want to sell bread to the town. Give me $100,000. Like their loan, Bank A gives me $100,000. That $100,000 is deposited into Bank B. Now they have to settle that flow from Bank A to Bank B. So they turn to the central clearinghouse. They give them $100,000 in bank reserves, and now that flow is settled. But what happens if the private bank doesn't have $100,000 in reserves? Well, they could go to Bank C, who has $100,000 in reserves, and lend it to them at a pre-specified interest rate, right? This is called the overnight lending market. And this is how the Fed used to, they don't anymore, and we'll get into why in a bit. This is how the Fed used to set a floor on policy interest rates, right? They would attempt to alter interest rates through adding liquidity of bank reserves, essentially lowering the overnight lending rate, which sets a floor because the overnight lending rate is a very safe market for banks, right? Why would the bank lend to me a mortgage or for my business loan? Why would they lend to me at 5% when the overnight lending market is paying them 6%? They wouldn't, because the overnight lending market is safer than my business. So the Fed was able to alter interest rates through adding or removing liquidity in this market, essentially offering a risk-free investment to the banks, altering that risk-free investment to the banks, setting a floor on interest rate, right? And this is called a scarce reserve regime, right? In a scarce reserve regime, open market operations is successful at stimulating the economy through lowering interest rates, which increases the quantity of positive net present value loans available in the economy. And under this system, it is the presence of positive NPV loans that is the main driver of money creation. That is the binding constraint in money creation. The presence of positive net present value loans, right? Because private banks are the ones creating the majority of the money in the economy through loan creation. And that is the key nuance. Yes, the Fed has a lot of influence over the interest rate, but they are not the ones individually creating money. There are binding constraints. There are binding constraints to that money creation, and that binding constraint in the scarce reserve regime is also the bank reserves. If there's not enough bank reserves, they can't make the loan. But also, the binding constraint is the presence of positive net present value loans, right? But what happened to the 2008 financial crisis, right? The Fed, what they try to do in these crises is they try to lower the interest rate. The goal is to stimulate the economy by lowering the rate, lowering the cost of borrowing, which causes more business activity, which stimulates the economy, right? But the Fed did this to an extreme degree. As we see here, the Fed did this to an extreme degree. And what happened to interest rates? What happened was the interest rate fell to zero. The interest rate fell to zero. And what can you do when the interest rate falls to zero? You can't really stimulate anymore. You can't stimulate anymore. So this is what we call an ample reserve regime. Reserves are no longer scarce. There's trillions of these things all over the place. The banks don't even know what to do with them, right? So what can the Fed do to stimulate the economy when the interest is at zero, right? They can't go below zero because, maybe you could charge them for bank reserves, but then people take their cash out of the banks. They don't want to pay negative interest. They just take their cash out of the banks. So what do? Right? Well, the Fed, what they did is something called quantitative easing. And here's the thing. People associate quantitative easing with money creation. But that's not really the case, right? What quantitative easing is a special kind. It's a type of our open market operation. And what they're doing is they're buying a longer dated treasury. Usually in open market operations in normal times, they're buying short-term treasuries, right? 0 to 3 month treasury bills from the banks in exchange for bank reserves. But you see here, when the rates fall to zero, what can they do? They can't make rates below zero. But longer-term treasuries tend to have higher rates, higher yields than short-term treasuries, right? So when interest rates hit zero, what they did is they bought large quantities of longer maturity treasury bonds. And that was an attempt to lower this rate, because if the higher the price of the bond, the lower the yield on the bond, right? So they were trying to lower the yield to further stimulate the economy, right? That's all quantitative easing is. Quantitative easing is not money creation. It's an attempt to manipulate the long-term treasury market to be cheaper. So the yields are cheaper to further stimulate the economy, right? That is vastly different from money creation. And let's reiterate, right? How is open market operations stimulatory? How is it creating new loans in an ample reserve regime, right? They're printing all these bank reserves, but it's barely moving the needle. And frankly, it's debated amongst academics whether they're even effectively lowering the yield on long-term treasuries. Yeah, maybe they're doing it through signaling, but mechanically there's a lot of debate, amongst academics whether they're actually lowering the longer-term yields, right? And this was incredibly controversial. People were scared. People were saying, oh my God, there's going to be hyperinflation, right? But they failed to consider several things, right? One, bank reserves are no longer a binding constraint on money creation because the Fed supplied tons of them, right? We discussed this. Bank lending is constrained mainly by the demand and the supply for loans, as well as being they're being within the regulatory requirements of the Fed, right? And then three, deflation is a much greater concern during economic recessions like 2008, and measures like quantitative easing is implemented through these economic downturns, right? When rates hit zero, they ease. They ease. And this is following the 2008 financial crisis, following quantitative easing. If you look here, there's some periods above 2%. So the Fed has a target, I should specify. The Fed has a target to keep to keep inflation above or close to. They have a target of 2%, right? But the Fed was really struggling, actually, despite the quantitative easing, to get inflation above 2%. In fact, there's even short periods of deflation here in 2015, despite quantitative easing throughout this entire period, right? And again, that's attributed to the fact that bank reserves, the Fed's actions, the Fed's open market operations, was insufficient at stimulating bank lending because we were pretty much already at the zero lower bound. Interest rates were zero for a long time. It doesn't matter how many bank reserves the Fed is throwing at the banks, it's not going to lower the interest rate anymore, right? It's not going to, because rates are already at zero. You could throw as many as you want. Rates are at zero. You can't go below zero, right? Well, you can, and we're going to get to that right now, actually. We're going to get to that right now. So how does the Fed set rates in an ample reserve regime? How do they do it, right? Because we just discussed that when rates are so ample, you throw trillions of bank reserves at the banks. They don't even know what to do with it. How do you set rates in this regime? Well, there's two main ways the Fed, and it's actually here, you see here the IOR, the interest on reserves, and the reverse repurchase agreement. Basically, what the Fed is doing is they're offering a risk-free investment. Remember when we talked about the overnight lending rate? This is a very risk-free investment to the bank, which essentially sets a floor. Why is the bank going to give me a mortgage at 5% when they're getting 6% of the overnight lending rate? Well, what the Fed is doing now is they're offering essentially two risk-free investments to these banks. For one, they're paying interest on their idle reserves. So, yes, there's trillions of bank reserves. The rates are 0%. But regardless of that, the Fed is going to say, hey, we'll pay you 5% to just keep those reserves. We'll pay you 5% just to keep those reserves. It's a risk-free investment. Again, we have that risk-free investment for the bank. So why would the bank lend me at 5% when they're getting 6% from the Fed? There's no reason to. And same here with the reverse repurchase agreement, right? Banks invest in overnight with the Fed through a repo, which is another risk-free investment for the banks. And we're trending towards this regime, right? The standing repo facility supports the shift towards the repo market's growing importance. So the Fed will increase or decrease interest rates, which essentially increases or decreases the supply of positive net present value loans for these banks, right? Money is created when banks and consumers find productive uses for that capital. And this is the nuance, right? When the bank gave me $100,000, they created $100,000 out of thin air, right? But what am I doing with that money? What am I doing with that money? That $100,000, I'm using it to build a business. I'm using it to bake bread. And what happens when the supply of the bread goes up? Yeah, the money supply went up, but also the supply of bread also went up. So the creation of money is partially offset, not fully offset, but the new money from that loan is inflationary, but it's partially offset by the deflationary impact of the increased productive capacity of the economy. And this is why I think this fiat model makes a lot more sense than imposing an arbitrary constraint like a gold standard. The arbitrary constraint of the supply of a commodity like gold. And this is what happened during the Great Depression, right? During the Great Depression, there was massive outflows of gold leaving the banking system, right? There was outflows of gold leaving the banking system to the point where the banks, they saw fit to raise interest rates to keep the gold within the banking system, right? But this is during the Great Depression. We know that when the economy is doing poorly, we want to stimulate the economy through lowering the interest rate to spur lending activity. But the opposite was happening during the Great Depression because we decided to impose this arbitrary constraint through the supply of this commodity. But the constraint now in modern economies isn't just the willy-nilly money printing of central banks. It is the supply and demand of positive net present value loans, profitable loans available in the economy, right? Banks aren't going to lend if they don't believe the loan is profitable, right? Yes, there could be some speculative activity, but really, if we assume rational agents, rational banks, rational consumers of these loans as well, right? We see the money supply will scale roughly in tandem with the productive capacity of the economy. And that's why I believe modern monetary systems make a lot more sense than the gold standard that preceded it. So a lot of you might have questions, right? We lived through the pandemic, and following the pandemic, there was a raging inflation crisis, right? We saw inflation rates reach 9-10%. Some of our grocery items went up 20-30%, right? What happened? I just ranted to you for 15 minutes talking about how the Fed isn't printing money, and here they are, printing money, and inflation is skyrocketing. What happened, right? And again, this is why I said this video is going to be controversial, right? Because a lot of people are struggling with inflation. There's a cost of living crisis, especially as it relates to housing, and people hate to see the rising grocery prices. But I do not think this is attributed to the Fed or to money printing, right? So this is a study conducted by the San Francisco Fed, right? What they're doing is they're estimating whether inflation is attributed to demand side or supply side, right? So when demand for something goes up, the price of it goes up. When the supply of something goes down, the price of it goes up, right? Those are the two main drivers of inflation in an economy. And their findings were that a huge proportion, roughly half, was attributed to supply chain and logistical issues related to China's no COVID policy, and a variety of other, labor constraints. And yeah, if you remember that time, there were major supply chain and logistical issues during COVID. And what they did and how they decompose it, right? The demand-driven inflation is a combination of aggressive government spending and stimulus. Again, that's unrelated to the Fed. That is stimulatory, right? The government was handing us $1,200 checks, and there was a lot of stimulus, government stimulus. And can some of it be attributed to the Fed? Yes. They lowered interest rates. That spurs lending activity. That is inflationary. But if we look at the inflation, more than half of it is attributed to supply chain and logistical issues. And we also have the fiscal authority to blame, partially, for this demand-driven inflation through their stimulus checks, So, did the Fed cause inflation in 2022 or following the pandemic? Yes. They had something to do with the inflation. Did they contribute the vast majority of the inflation? Not even close. I would say my rough estimate, and don't quote me, I'm not this is not a hill I'm gonna die on, but my rough estimate is that the Fed had roughly 15 to 20% to do with that inflation, right? I would say the bulk of it has a lot to do with the supply chain and logistical issues and the government stimulus. And really, the main thing I want you to take away is distinguishing between what a bank reserve is and what money is, right? And how money is created is through profitable lending. Profitable lending. So money supply will only increase when a bank foresees positive net present value loans, which is a far less arbitrary constraint on money creation than the supply of a random commodity like gold. And I'm sorry for being so controversial today, but I hope you learned something. Let me know if you guys have any questions in the comments section, and I'm out.